all of our Middle Eastern currencies are in some way pegged to another currency or a basket of currencies of their trading partners. Again, we're doing this because we know as professional traders that it doesn't matter how big a country is, how big a currency is. It's really what matters is really the volatility of the asset itself. So when we move into Asia, we see that we have a large list again of emerging currencies in Asia, and a whole bunch of them have got dependency on commodities. And we also have a few of them, so the Chinese yuan, the Hong Kong dollar, and the Singapore dollar. These currencies are pegged regimes similar to GCC. And pegged regimes do have different nuances. We're going to look at those in more detail in video number 2. When we go into emerging currencies in Latin America, we can see that all Latin American currencies have some sort of dependency on commodities. And what we also notice is that there's no P's here next to our letter C's. So they're commodity dependent, but they're not pegged. They're actually floating. So when you go through the list here, you'll be able to see that anything that doesn't have a P is actually a floating regime. And anything that does have a P is a pegged regime. Now, as professional traders, we've mentioned or briefly skimmed over this, that as professional traders, what really matters to us is volatility. So when we define currencies, we don't really care that a country is in the G10 or not. Why would we care? As traders, what we're seeking out is volatility. So I want you to imagine, for example, a time horizon, and the time horizon can be any day, any time horizon at all. So it can be 1 day, 1 week, 1 month, 3 months, 1 year. And I want you to imagine just any asset. It can be currencies, stocks, commodities, bonds. It can also be bricks. So bricks are used to build houses. Bricks have a price on the open market. And manufacturers and wholesalers, distributors, developers, they buy and sell bricks in the open markets. They buy and sell bricks with each other. Bricks have a price like any other asset, and every asset has a marketplace. And over any given time horizon, what really matters for the people trading these assets is the volatility of the assets. And if we just pick 1 day, for example, as our time horizon, and we pick a currency, so let's pick a random currency pair, for example, like the euro US dollar, and say, okay, over 1 day, we're going to buy and sell this currency, the euro dollar, over 1 day, we're going to trade it 10 times. And we're going to look at the daily volatility of euro dollar. And let's say we find that the euro dollar over a 24-hour period just doesn't move. Well, it means that when we buy and sell it, we're buying and selling it at the same price if it doesn't move. And if we're paying a broker a commission every time we trade, so a spread, and it can be a very small spread, it doesn't really matter. But if in theory the price is the same over a 24-hour period, and we buy and sell it 10 times and pay to do so, it means that we're not going to make any money. In fact, we're just going to lose money. However, if we do have volatility, then an opportunity and risk is created. As professional traders, that's what we care about. We don't care that something's in the G10. We don't care that it's in Latin America. What we care about is what the currency's regime is and what the currency is dependent on. And this is a driver for volatility. So instead of organizing and segmenting currencies by geography and transaction size, we organize currencies by the potential opportunity. And the way we do this in the first step, and there are further steps that we go through later in the video series, but the way we do this in the first step is to segment into 4 main categories, which are X commodity floating, X commodity pegged, commodity floating, and commodity pegged. So what we're doing is we're filtering here by currency regime and commodity exposure. So the X commodity grouping here are currencies that are not dependent on 1 or 2 commodities in their exports. And these split up into floating and pegged regimes. Then we have the commodity floating and pegged, which are countries that are split up by or filtered by their dependency on 1 or 2 commodities and then by their regime. And if you go into the download section of the video series, so under video number 1, you'll see a download button. You'll be able to download the spreadsheet, which segments everything for you. And if you download that spreadsheet, have a look through it. Just familiarize yourself with it, because it's important to start getting familiar with these definitions, because we build on these things later.